Join?
He will not join, sir.
He'll not be able to join today? Okay, that's all right. So from the ASSOCHAM then, today we have Mr. Agarwal welcoming us, and then we have Mr. Rohit Vora. Is that right?
Yes, sir, you are right.
Yeah, good afternoon, sir.
Rohit Vora ji, can we
Yeah,
see you?
good afternoon, sir. Good
Good
afternoon,
afternoon.
everybody.
Good afternoon. Fine. So I think then the house is ready. We are all there. I would request Agarwal ji, you actually start with the welcome remarks, and the chairman knows that you are there. And then we do not have today Sachindra Nath, but we do have Rohit Vora, who's from SHM. So SHM is represented today by two people, Mr. Agarwal and Mr. Vora.
Thank you. Good afternoon. First of all, I would like to congratulate ASSOCHAM eGrow Foundation and its officials for conducting discussion on forthcoming monetary policy. On ASSOCHAM and eGrow Foundation, and to welcome Dr. Arvind Varmani, former Chief Economic Advisor, Government of India, and Chairman eGrow Foundation for us today, and he is the moderator of this webinar. I would also like to welcome and honor other panelists, Ms. Upasana Bhardwaj, Senior Economist and Executive Vice President, Kotak Mahindra Bank, Sri Arjun Nagarajan, Chief Economist and Committee Member of Madras Chamber of Commerce, Sri Siddharth Sanyal, Chief Economist and Research, Bandhan Bank, Sri CMA Rohit Voraji, Rohit and Associates, Coast Accountant, and Dr. Charan Singh, Chairman, ASSOCHAM National Council for Banking, and always wonderful speaker. At last, I would also like to welcome you all who are with us during these deliberations. Monetary policy is a central bank's action and communication that manage the money supply. Central banks use monetary policy to prevent inflation, reduce unemployment, and promote moderate long-term interest rates. In the last monetary policy making, we have seen that repo rate remain unchanged at 4%. Continue with the accommodative stance. The MSF rate and the bank rate remains also unchanged at 4.25%. The reverse repo rate also remains unchanged at 3.35%. So RBI has supported the growth of economy while remaining watchful of inflationary pressure and continued policy support with a focus on revival and sustenance of growth. Most economists cited concerns about inflationary pressures in the economy and rising household expectations, but felt it was too early to increase the repo rate. So we are expecting the accommodative monetary policy stance to remain in October 2021 policy review as well. I would like to highlight certain facts about the economy. FDI equity inflows up 112% to 20.42 billion US dollar in April to July. Goods and service tax, daily e-way bill generations gain pace. Exports at $185 billion till September 21. India reports 29% surge in employment across 9 sectors in June quarter. ICRA Care raised growth forecast on decline, decent quarter 1. Foreign exchange reserves rise USD $34.1 billion in June quarter. Core data points to strong recovery in infra and economy. Retail inflation for industrial workers eased to 4.79%. In August, fiscal deficit touches 31.1% of annual target at end August. Lower trade deficit, higher software exports contribute to current in surplus in April to June 2021. Once again, I would like to thanks and welcome all the panelists and the audience and distinguished guests. Thanks to ASSOCHAM and eGrow Foundation for giving me this opportunity to welcome address. Thank you very much again.
Thank you, Mr. Agarwal. So we can start the discussions on the monetary policy. So as usual, I will start by giving a brief macro picture. And as I pointed out last time also, please, the participants feel free to disagree with any projections I made. Obviously, I mean, it's always good to have, because many of these actually involve judgments and people can have different judgments. So let me start with a little review. For the last 12 months, we have been saying that the growth rate for the current year, 2021-22 or FY22, will be 10% plus minus 1%. And despite the second wave, etc., and we explained why we stayed with that growth projection, and it has remained on track. I've had little occasion to change it. Many others have had different views, but that's fine. And I still believe we are on track. Now, there are two interesting things that almost 9 months ago, we had pointed to this issue of logistics and supply chain disruptions. And there's some interesting contrast, actually. We had expected that it would happen in India and also abroad. But the interesting thing is that the Indian disruptions were last year also quite small and were quickly overcome. And having learned from that, the domestic disruptions, even after because of the second wave, have been very minimal. In contrast, the global supply chain and logistic disruptions have not only exceeded what at least I had imagined, but in fact have worsened with the Delta wave reaching various countries. So that's an interesting twist which others may have occasion to point to. But what that means is that one has to keep in mind this unusual situation in which some of the inflation, again, we can have different views, that some of this inflation, how much of it is due to these supply chain disruptions, how long these supply chain disruptions will last, and therefore how much of the inflationary impact is temporary and how much permanent. So my general view has been that most of it is temporary, but again, this is a matter of judgment. There are certain elements which we know, for example, the semiconductor stuff, which there are forecasts that it may last a year or perhaps even more. The second point I would make is that on future growth, I think the phenomena of supply chain diversification has been given a boost by this logistics disruptions. I mean, earlier it was an issue. I mean, it all started with President Trump's tariffs on China, and then it's gone through many stages. And again, in the last two sessions, I have been pointing out that my feedback is that it's becoming increasingly firm, and that is reflected in the exports. Of course, again, part of the export growth is due to the recovery of the world economy. Growth forecasts of every multilateral institution have gone up. So part of it is clearly that, but I think part of it is the shift of supply chains from China towards India. And I'm beginning to see, perhaps our stock market friends who are familiar will tell us more, but I'm beginning to hear this very cautiously people are beginning to make this point. Nobody says it's a shift from China to India, but they say this indirectly: diversification of supply chain, China plus one. I'm beginning to hear even. So given that, again, it strengthens, and the reforms that India has done over the last, since September 2019 are again becoming increasingly known domestically and abroad. So given all these things, again, I have a stronger belief in my forecast for the decadal forecast of 7 to 8%. Of course, there are many dangers. So let me, so one of the implications of that, and then some of the weaknesses which I see. So I think one of the implications which I draw, and I'll say a little bit more about this, is that the action kind of has to shift from monetary to fiscal policy. So monetary policy, mine like any others, the initial stance was to just maintain the current stance and maintain the current situation. But there is only one kind of danger that I see, and then I'll go back to this macro weakness. And that is the issue of asset price inflation. I'm not sure there are firm indicators of that. Again, my panelists may want to say something about that. I'm actually less worried about demand-led inflation. Of course, we already noted the supply side and whether that could turn into a permanent one. And the second one, again, which people may want to say more on, is the oil price, which does affect us in various ways. So I would say that's more of a watch situation for me. Now, the third point I want to make very quickly is this, why I say that I think the focus of the government has to kind of change from monetary to fiscal policy. And I want to make some points here. Even though, this is supposed to be a largely monetary policy discussion, but as you all know, the pre-budget meeting will start in October, and probably by December or so, most of the decisions are made, by the end of December. So we'll have two occasions. I may repeat some of this in the next meeting and also at the pre-budget meeting. So very quickly, there are kind of three weaknesses I see in the macroeconomy, which I believe require action, and I have my own proposals. Others may have, besides the usual ones, which we have been discussing for the last 2-3 meetings. So one is that the informal sector jobs have seem to have been affected, particularly the urban ones. Now we know that part of that is because of the service contact sector services, and will improve with vaccination, etc. But it's still, I think, an issue of concern in the sense of how quickly the recovery will be, or how complete it will be. The second element, which has not been noticed anywhere, actually, which I discovered in looking at the rural wage data, is actually the surprisingly, it's the these numbers I've seen somewhere. I don't know what the source is, but the numbers suggest that 20% have workers have regular formal employment, and about 20% is informal urban, and 20% informal rural, and 40% agriculture, informal, which is mostly informal. So between this 40%, which is informal, half in urban, half rural, the interesting thing when I looked at this, what I find is a very strange phenomenon. The ratio of agricultural to non-agricultural, the ratio of non-agricultural to agriculture rural wages has been declining for several years, and the pandemic has accelerated this process. Now, this is based on averages I make from the data which comes out on rural wages, but that's very interesting. What that suggests to me is that there is a problem there with respect to services beyond the pandemic, so to say. So this is the second problem I say, and the effect of some of these things we are seeing in the private sector. That's another data point which is relevant to this weakness, is the private demand, which some of you, I think Mr. Sanyal and others have been making this point. The 2 points, of course, now we have the GDP private consumption, and of course, Mr. Sanyal had pointed out the CCS, the RBI consumer confidence survey. I take that on board. I think it is a little worrying. So this private consumption, and finally the element that corporate sector in some sense is growing and recovering much faster than in MSME. So these are four areas of concern which I have, and there's one opportunity, and then I'll give the solutions. Well, let me give the solution. My solution is really a revenue negative reform of the direct tax code and the GST. I think particularly the GST, for 20 years, I've been a votary of revenue neutral reform, but I think given the macro situation, for the first time, I'm now saying, well, since I said this at the RBI governors meeting, that we actually now need not just a revenue neutral GST simplification, but a revenue negative one, which means deliberately reduce the current average rate. I won't go into the details. I've said these many places, the simplification, but I'll leave it at that. And the second one on direct tax code, we've reduced the corporate tax, we've reformed the corporate tax, but we've in a way made the playing field unlevel for the MSMEs. So we need to correct that by doing the direct tax code reform. And here I will appeal to ASSOCHAM, and your members to take this up as one of your points in the forthcoming pre-budget meetings. I think it's a very important thing. It's a timely. The reform part is necessary anyway for structural reasons, for sustaining growth of more than 7% over the next over the decade. But at this particular time, I think it's more urgent to get a quicker recovery on these 3 or 4 points which I made. The final point relating to the opportunity side, the macro strength, I think, again, Mr. Agarwal pointed to some of these things, that the export growth, the high capital inflows, the rise in reserves all suggest that this may be a good time to do customs tariff reform, okay? Because generally, when your balance of payments or current account is weak, you don't want to take a chance. You're afraid. Country is afraid. But this is a great time to add to the export growth and make it more self-sustaining, to join, to reform the customs tariffs, to be able to facilitate India joining the supply chains. And so there's great opportunity. We are beginning to enter it, but why not really give a big push to it and generate more labor-intensive exports, which will also, again, contribute to solving these 3 or 4 previous problems I've said. And the 2 elements of that are now well known. It is one is the dispersion of rates. For example, in the textiles sector, because of specific rates, there's a huge dispersion of rates which is really outdated, which needs to reform. And secondly, the average rate also needs to come down because till 2018 we had the lowest average rate. The WTO data shows that India had actually had the lowest rates in 2018 over the 7-year period for which I looked, past 7 years or 8 years, 9 years. But then in 2019 we raised them. I think it's a good to rethink that. We don't need to raise the average rates. What we have to be is very selective and coordinate with the PLI scheme, not raise the average rate of tariff. So these 3 reforms I point out, as I said, these are not directly related to monetary policy, but some of the problems, I'm sure some of our other discussions will take up and link them to the monetary policy. With that, let me call on our first speaker. I think it's Upasana. Mr. Nath is not here, right?
Yes.
Yeah. So, Mr. Upasana, you are the first.
Yes. Thank you, sir. Yes. Good afternoon, everyone. Yeah, a couple of points on the growth side. Broadly, I would agree. Okay, so just to set the context, we are looking at GDP at 9% for this year. And we have been expecting this since the second wave hit us. And I think broadly, this seems to be working in line as we go ahead. Now, there are a couple of things from a structural basis, which I think Dr. Virmani also kind of alluded to. There is a clear distinction of the organized sector doing far better versus the unorganized sector. So the MSMEs becoming probably weaker, and the larger corporates being highly rich on cash. We haven't seen that kind of a cash surplus with the large corporates ever, and that's one of the reasons why the bank credit, if we look at the details, the bank credit to the larger corporates is not there, not because the banks are probably not willing to lend them, but probably there's no need to expand in especially this kind of environment. So that divergence, that K-shaped recovery is actually real, which we will have to see how that really affects the structural growth going beyond just this year, or probably beyond just to the next year. And that is going to be very crucial. That's exactly where the fiscal policy will be very crucial. I really don't see incrementally monetary policy playing a very important role. If at all the excesses that the monetary policy has introduced in the past over the last 1.5 years, we are on the brink of an exit policy. It is going to be important because for a stable economy, we know that inflation too has to be stabilized and anchored at relative low rates. There could be differences in opinions about what level of inflation is probably apt for an economy of ours. But even if we were to look at inflation expectations, they have been faring high. And crude oil prices, I think the bigger challenge that we face right now is that the excise duty on petroleum products have been so high that it is going to definitely accelerate the inflationary expectations. That is something, food inflation or petrol price inflation, that is something which really gets entrenched in inflation expectations, because that is the real amount of, that is the inflation which an Aam Aadmi really feels. So I think that is where the problem lies. As long as we don't really see a structural change to excise duty structure, there is going to be an upside risk to inflation expectations. And at the same time, obviously, again, I would agree with Dr. Virmani in the sense that monetary policy related liquidity does not result in goods and service inflation. Actually, it results in asset price bubbles, right? It really pushes asset inflation much higher. And that's exactly what's happening globally and for India as well. So that again remains a challenge. And RBI will have to address it in whichever form. So coming now to how we are looking at inflation, growth, and hence expectations on the policy. Growth is reviving, and yes, there could be differential pace, multi-speed pace of growth, but on the headline, the growth is picking up pace. The vaccination drive is doing very well in India, I think unexpectedly so, but 90 crore vaccinations have been delivered. So clearly things are going in the right path. And I think in that context, if you look at the inflation projections, near-term inflation projections of RBI are overshoot. I mean, the actuals will be much lower than what RBI has projected. So up until December or so, I do look at a reasonable 50 to 70 basis of a downside to RBI's projections. Beyond that, of course, we again start moving, and that's largely to do with the favorable base effect and not really that inflation sequentially is coming down. Now, going into the fourth quarter onwards, we start again hovering in the 5% plus range. The average will be 5.5 plus for sure. So now in that kind of an environment, if inflation is getting anchored more above 5% from a structural perspective, I think this does have a bearing on the medium-term growth prospects. So RBI will have to take some measures, and to take the measures, they have to act gradually, but they have to start acting, especially when the global backdrop is not very favorable. The US Federal Reserve has already at least suggested that they're going to start off their exit plans from November. The Bank of England is also probably going to go ahead with the rate hike because they're not very comfortable with inflation. We are seeing that kind of a turn of tide on the global side. And to add to that, for India, the bigger problem is the global energy prices. The crude oil prices are 10% up, crossing $80 a barrel over the last 10 days or so. And to top it all, we have now the coal crisis, actually. So the shortage that we are probably, it's somewhere in the making, wherein we could have issues and which could also hamper growth, but also cause inflation. We'll have to see how all of this pans out, but there is uncertainty with regard to all of this. And Hence, I think as we go ahead, RBI has to gear up on that account. What we think is that RBI has already started indicating through its signals that they're not comfortable with as much liquidity which is sloshing around in the system. So to begin with, just giving you an example, RBI had announced the asset purchase program, the GSAP program from first quarter to second quarter. In the second quarter, 30,000 crore worth of GSAP was due in September. What RBI did was, which is an outright liquidity infusion, just to mention, that 30,000 crore actually got substituted with a liquidity neutral tool. So they were doing a simultaneous OMO sale as well. So actually, they don't want any incremental liquidity from henceforth. This is front running it by 1 month ahead. What we thought was this would be the plan from the October policy onwards, but they already started acting from September. So I think that's a lead signal I would draw from RBI's actions as to what they're comfortable with. The second element is, of course, the excessive use of the variable reverse repo auctions. So again, in the August policy, they had announced 4 lakh crore that they will increase up to end of September. But by now, before the policy, we are at 5.5 lakh crore of VRRRs. Gradually, the cutoff rates are coming higher. Very slow process, but it is in the making. So I think RBI is basically somewhere moving, but it very, very slowly. And that also means that in this policy, I don't expect much to change materially because they will continue to use the VRRR as a tool. But I think important point here would be the guidance. And that is very important because the way Fed has gone about beautifully telegraphing its tapering program over the last so many policies, it is important that RBI too communicates very well as to what lies ahead. And that's where I'll be drawing cues from the statement. So while on the surface, amongst all the policy decisions, I don't expect any change to the policy stance. I don't expect any change to policy rates. And at the same time, like I said, I'm expecting some liquidity tweaking measures to continue. The GSAP program could be announced. They may not announce a simultaneous sale happening, but they will continue to do that. So I don't think that's, that should be read as a liquidity infusion measure, really. And amongst that, I think the tone will be slightly more guarded going ahead, which will be indication of the fact that probably we are nearing a reverse repo hike in December. Yeah.
Thank you. Let me just highlight 2 things. One is, I think, the point you made, which is a good point, but needs further reflection, that petrol prices, including the excise, what the public pays, it probably they are more aware of that and may affect inflationary expectation. That I think is a valid point. And this related point about coal, yes, I think the whole issue of potential coal shortages, electricity pricing, energy pricing, yes, I think that's something which one needs to watch and think about. Right, and of course, yeah, I think those were the 2 main ones. So with that, let me call on Mr. Sanyal.
Thank you very much, sir. I would possibly take the first couple of minutes to just try to jot down what had been the surprises in the last couple of months since when we had gathered in this particular forum for the last time. So very clearly from that point onwards, the COVID scenario has been a very clear, strong, positive upside that the fears of third wave, etc., have actually subsided very significantly in various parts of the countries. We are seeing the activity, normalization in activities coming at a pace which we had not been anticipating just maybe a couple of months back or 3-4 months back at least. Very clearly, as Dr. Virvani and Upasana also mentioned in the earlier, that the pace of vaccination is possibly at a cusp of a very strong positive surprise. So these had been the 2 very positive surprises or significant positive surprises of late. and benefiting from that particular thing, there had been a bit of an uptick in high frequency activity indicators in a number of cases, in case of PMIs, in case of e-way bills, etc., at times surprising on the higher side. But obviously the surprises on two other factors, more global than domestic, is generally the inflationary pressures and the way some of the supply related disruptions are coming and the kind of shape and form they are taking. They're kind of unheard of. The kind of news stories we have faced with in the last few weeks, like the way gasoline shortages in advanced countries or power shortages in a country like China and stuff like that. At this moment, possibly we are still not been in a position to do a proper evaluation of the medium-term effect of such events or developments. Basically, think of a situation that how complicated the scenario can be. If China's manufacturing base is on a weak footing for a while, in the very near term, that might lead to some kind of reduced demand for commodities in the very short term. But sooner or later, it actually feeds to some kind of significant bearing on impacting the pace of global recovery, as well as, given that China is often a supplier of relatively cheap manufacturing items, there is a bit of disinflation taken away from the system, or in other words, that's indirectly another inflationary element in the overall scheme of things, where overall inflationary pressures seem to be fairly strong and fairly virulent. So this kind of things are acting as very significant global uncertainties, and I think that overall, we are not in a position to appreciate it fully as of now. Against that backdrop, if I just try to see where had been our inflation forecast and growth forecast, just to try to make it slightly more related or link it up with the upcoming policy. The RBI is maintaining a 9.5% growth forecast at this moment, and our sense is that they will be maintaining it at around that level even in this particular policy. Earlier, we had been a lot more skeptical about that particular number at 9.5%. Our own number had been closer to 8%, if I recall correctly, what we had been discussing in this particular forum. But obviously, the relief on the COVID scenario is actually giving us a little bit of hope on the overall activity scenario, and we are moving closer to the RBI number, even though we are lower than the RBI's current number as of now. On the inflation front, very clearly, the RBI's 5.9% Q3 number, Q3 calendar year number is very clearly will be undershot by a significant margin. But the current developments are possibly a lot more daunting, and that is possibly not giving us any clarity on whether the overall full year 5.7% inflation forecast, which the RBI is having at this moment, whether even that number is safe, even though there has been a very significant likely undershooting of that particular of the inflation number for the second quarter of the financial year. So overall, even though in the near term the 5.3% average numbers in the last two prints is giving the RBI a little bit of relief or breathing space at this moment, I think the overall pressure on the inflationary front from the massive uncertainties from the global side has been particularly strong. Very clearly, there has been very strong pass-through of the global commodity prices, particularly in case of energy prices into domestic prices, which is, as Upashana rightly mentioned, that is a significant factor so far as inflationary expectations are concerned. And from our several on-ground, we keep doing some kind of dipstick studies on almost on a real-time basis with very small samples. So it's often difficult to say that talk about those surveys on a very formal basis, but typically more often than not they give us decent results. Very clearly there is a bit of concern so far as inflation expectations are concerned, even at the grassroots level over the course of the last month or so because of that particular factor. And the other factor which we are very clearly seeing at this moment, that or rather, I'll just wrap up the RBI possible policy action first and come to a little bit of more granular takeaways from some of the developments on ground. Very clearly, on the basis of this current growth and inflation scenario, there is absolutely no expectation of any headline rate action at this moment. There is a bit of an outside chance of the reverse repo rate getting hiked sooner or later. I think that has to happen because the 65 basis point kind of a corridor is fairly unusual, which the RBI had been maintaining only for the crisis time support, and they will possibly not be keeping it for a very long period of time. But whether they do it right now or they do it in one policy down the line, I think that should not be that should not lead to any major disruption. Here, the credit should go to the RBI that during the policy cycles, as well as outside the policy cycle, they had been fairly active as regards their communication with the market. And I think there has been a fair degree of sensitization so far as the market participants are concerned. And as a result, even if there is some bit of an action as regards potentially lowering of the GSAP quantum or increasing the VRRR quantum or even the reverse repo hike, my sense is that beyond the immediate knee-jerk reaction on the yields and interest rates, there should not be too much of an impact, because it's pretty clear that RBI will possibly not be moving on all the fronts at one go. That if they choose to move on the rate side, I'm talking only about the reverse repo rate, absolutely no question about the repo rate for a fairly long period, even from now. Even if they choose to, if they choose to move on the rate side, they will possibly be a little more lenient on the liquidity side. And if they decide to move on the liquidity side at this juncture, which is possibly a slightly higher possibility, they might actually show lenience on the rates front. So on that particular, in that kind of a setup, the monetary policy at this juncture is possibly well set to play the role it can potentially at this moment, that not to cause any disruption while gradually exiting from the excessive support that they had been providing in the past. In the recent past, the RBI had been fairly supportive for the overall growth, for the cause of growth and growth support. I don't think at this stage of initial and uneven stage of recovery, they will be doing anything different for sure. Before I complete on at this round, I'll possibly be trying to touch upon a couple of other points which we keep on seeing on the ground. So far as some of the smaller units, MSMEs, etc., that we typically try to stay in touch on a fairly regular basis. In case of MSMEs, the degree of concern still remains to be fairly high. That they're in a slightly favorable situation because of the improvement in overall logistics related scenario, as well as generally the receding COVID scenario in various parts of the country. But the supply chains that they depend critically on from one part of the country for their raw material as well as finished goods, and typically in many cases it's the same chain, that the same big industrial houses keep on sending it to them, and as well as the finished product they pick up. In at least half of the cases, these supply chains are yet to get restored fully. So that still continues to be a very significant problem. And on the top of that, if the market-driven input costs are rising at such a rapid pace, and if they need to take recourse to some of the market-driven, market-based raw material sources, that's possibly a huge dent for their, that's a source of vulnerability to put it clearly. So that remains a very significant concern for them. And one particular thing we keep on checking very closely all the time, that there has been quite a bit of positive restoration of positive sentiments of given that the COVID second wave is behind us for a fairly long period of time, when we keep on thinking that there should not be any further worry on that particular aspect. But what typically happens in case of some very small MSMEs, often they try to fight against that big shock for a while and survive for a while, but not necessarily that they survive for 3 months doesn't necessarily mean that they will be surviving the 6th month or 9th month. I think that particular risk is clearly underestimated at this moment. And if there is if the slightest hint of that particular number going out of proportion at any point of time, there has to be some kind of policy intervention potentially at all possible levels, at the levels of Chamber of Commerce or associated bodies, or even at the highest level of policy making. So we have seen a few of such cases here and there. It's still not such a high number, but I think that particular risk is very underestimated at the moment, and we need to take guard against that particular factor I wanted to highlight. Some of the factors, I think I've spoken for a long while, so we'll not get into further details, and has been mentioned by Dr. Virmani and Upasana both in the beginning. So we'll not get into the details of that, but yes, indeed, given that the dependence we have on the turnaround of private consumption in this particular recovery phase, it's very critical to see in this particular round that what is the scenario of consumer confidence that we get to see. We haven't seen any improvement as of now for a while, but in some of the smaller markets and all, whatever, again, taking recourse to our dipstick studies, we have seen some bit of uptick in, as the festival season nears. So to some extent, there might be a bit of an improvement. We are desperately hoping for that in the Pan-India numbers going ahead later this week. Overall credit growth, not very positive expectation from our side. The 7% odd number might inch a little higher, but not significantly higher is our baseline scenario. But the kind of deleveraging that we had been seeing in certain segments of smaller units, etc., in the earlier in the summer, we possibly have come. We are not seeing it at this moment. So things are stabilizing to some extent, but very still significantly away from any meaningful turnaround or declaring victory anytime soon. I'll stop here. Happy to take questions later on if any.
Thank you. I should just note that, Mr. Sanyal is probably the closest to the small sector, the rural areas, from the Bandhan Bank. So in some sense, we have to keep in mind that his perspective is the part where there is a problem, which is what I try to distinguish. So I don't see any inconsistency between what he says, because that was the weakness is in the informal sector, in the MSME, in certain poorer segments of the population, which he sees more clearly. And I would just say, perhaps that influences your judgment on the overall, but because we, from sitting in the macro, we just predict the GDP numbers which will officially come out. We are not really trying to second guess those numbers and bring in, the informal sector, but it's very important for the discussion to have that perspective and to be aware of it and see how policy can influence that. One more point I would just add, of course, so it's encouraging. You're saying there's a slight uptick that you see at the ground level on the micro.
In consumption behavior, people are still very conscious about their budget and all, but still a little bit of uptick that we
right. So that is encouraging. Why? Because the CMI data on projects is showing a little bit of similar uptick. Very small, not clearly whether it's a trend or not. So, the way that is explained is that there are parts of the economy which apparently their low capacity utilization is being reversed, and they are now actually thinking of small parts right now, thinking of renewing or restarting their expansion programs, etc. So, but these are small indicators. We just took note of them. In this context of investment, I want to re-mention this point I made last time, which was about the digital economy and the startups. The kind of money which is being raised and spent is what we call autonomous or exogenous expenditures, which actually in a macro economy play the same role as the physical investment which we are used to. So even though we will not see that in the physical numbers which we are used to in the GDP and elsewhere, but that has the same effect on the overall macro economy and the demand as investment does. It's defined as autonomous expenditure, even though it's just losses which are being, the money is just being spent without getting a return, but it still has that effect on GDP. So that is something people may keep in mind. I guess on the list we have Mr. Vora. Charan, should we go to Mr.
Yes.
Vora and then come to Mr. Nagarajan? Yeah, so Mr.
Sure.
Vora and then Mr. Nagarajan. As usual, Dr. Charan Singh will be the last.
Yes, sir. So I have limited submission is that we are having the public data of consolidated informations. If we have informations related to the relevant abnormal effect as well, like say in our present scenario due to the COVID scenario. With that COVID scenario, what are the relevant impacts on the data if it is available, and if we keep it in the system itself? Say for example, in a change in the repo rate, we are maintaining the repo rate constant. Due to the COVID situations, how much is the variation? If that is also given, we could analyze the situations on the those abnormal effects. So due to the abnormal effects, whatever the effects in the policy we are having, if that is also available, it could be in a better understanding. And another submission is that I agree with Mr. Sanyal is related to the effect onto the MSME sectors. MSME sector rightly can sustain to a certain extent, but if it requires on a longer durations, then the situation could be different. That is the only limited submission, sir.
Thank you. With that, let me invite our new guest, Arjun Nagarajan, Chief Economist, Sundaram Mutual Fund. Mr. Nagarajan?
Can you hear me, sir?
Yeah.
Yeah, thanks a lot. Thanks a lot for the invite, and quite an honor to speak amidst stalwarts and experts. So I'll try to keep it brief because I'd like to hear much more from all of you and get a better understanding. So I'll just stick to the brief and give my 2 cents as to how we're looking at the policy. So 2-3 things. From a monetary policy point of view, we've been of the stance quite contrary to what the markets have been talking about. Markets have been talking about normalization for a while now. So we've been trying to say that there's no sign of normalization in the near term, and the RBI is fairly clear. So I think in a normal sense, from a monetary policy point of view, there's generally a question of what the RBI should do and what the RBI will do. This time around, I don't think there's much of a twain there. I think they are doing what they should be doing. So that will do and should do, I don't think there's much of a difference in this time under this current regime. The other point that I thought I'd like to highlight is if you're looking at it, there's been a small narrative over the last few days about how the RBI is likely to raise the reverse repo rate, and they've based it on the variable rate reverse repo cutoffs that actually were expected around 3.99 or so, much higher than what they had expected earlier. So 2 things here. So from a variable rate reverse repo point of view, I think the RBI has time and again reiterated that this VRRR measure is not to be read as a sign of normalization, and Dr. Patra had reiterated that in his speech last month. So he gave a very beautiful speech where he sort of completely shifted the new glide path of the RBI to a 4% by 2024 and 5% only by 2023 or so. So from that standpoint, I think this monetary policy on Friday, we'll have to see if how much of Dr. Patra's views are being endorsed formally in the policy. I think that will be a very important thing to look out for. And if they do endorse, I think that will be an added layer of accommodation, at least from a market's point of view, or rather a dovishness from a market's point of view. I thought I'd start off my arguments with credit growth, but I think Ms. Bharadwaj's comment on credit growth in the corporate sector, where savings have been fairly high, that is the reason why they're not really going to the banks as much. That sort of stumped me. I didn't think of that. So even if I take that argument off, I think there are a number of uncertainties. So number one, I think Shaktikanta Das will be getting an extension, but nevertheless, that is still a question mark. We don't have any official confirmation as yet. So when there's at a point in time where there is a question there, I don't think there's going to be an inflection policy. I think that is a very important structural point. Apart from that, I don't think the RBI would want to preempt the Fed, though we have a very clear sense as to how the Fed is going to come through. A taper will happen in December. They've given a sense that the taper will happen within 6 months, etc. I think preempting the Fed would actually mean that we are giving a lesser time for the economy to sort of experience continued accommodation from a rate standpoint. So I don't think the RBI will be preempting the Fed. The other bit that all earlier speakers have also mentioned about is that you are seeing inflation softness. So we are at 5% plus on inflation. The US is also at 5% plus inflation. The drivers are very different, but we are very clearly seeing inflation in the months ahead coming off. And that is no argument for normalization as well. There are a number of, you have energy crisis in Europe, you have energy crisis in China. That is still something that is playing out. We still don't know how they're going to play. And a good part of the Chinese energy crisis is also on account of the self-imposed clampdown that has happened, in addition to the significant skyrocketing natural gas and coal prices. The other two bits that I want to highlight is we don't really expect a third wave. So officially our view is that on single dose vaccination, we are at 75%. And by end November, we'll be almost at 100%, assuming no vaccine hesitancy, we should be at 100% of single dose vaccinations. Double dose is already at 25%. And one very significant thing that seems to be missed out in the narrative of vaccinations is the fact that the July seroprevalence survey came out and told us that 68% of Indians have COVID antibodies in the adult population. And a very similar percentage was also seen in children, though they hadn't really, we still don't have vaccinations for children as yet. So if you're looking at it at how the states have played, the seroprevalence survey actually told you that in July that Kerala had the lowest. It had around 44%. And if you look at the numbers that played out from July, it was very obvious that the only way out for India to move forward is to accept that the cases are going to stay, and the opening up was the only strategy. So you sort of move towards herd immunity. So in addition to the 75% single dose vaccination, I think the 68% seroprevalence, I think, is a very significant backstop that will prevent a third wave of sorts. And like Dr. Virmani was talking about, unless there's going to be a very different variant or a very different R0, I don't think there's going to be a third wave. It might be a ripple of sorts, but not a wave. So I think that is a positive, but nevertheless, it is a point of uncertainty from a central bank point of view, because I don't think they will want to preempt that. And lastly, from a festive season point of view, I think both the markets and the RBI are very closely watching how the festive season is going to be. E-way bill numbers for September saw an appreciable jump, 6.5% month-on-month increase. They're expecting October to actually be better. But unless we really get a very good sense on the numbers as to how the festive season has played out, I don't think the RBI will want to preempt. So all these have been rather the pillars that I'm actually looking at, we are actually looking at from a policy point of view, and saying that there's going to be a status quo. The only two things that I think we'll have to keep a very close eye on is what the quantum of the GSAP numbers they're going to announce. in addition to what their view will be on VRRR, because we feel the VRRR is more a rate calibration from a weighted average call rate point of view. So if you look at the call rate from the last policy to now, it's gone up 10 basis points from 312 to 322. It's still well below the reverse repo rate. So broadly on policy, I think normalization for a fair bit ahead. If at all, I think repo rate normalization, reverse repo rate normalization would be possibly mid 2022 is what would be a reasonable timeline, I feel. I think I'll stop there. Thank you.
Thank you. Yeah, there are a number of points I just want to note and maybe add a comment on. I think the glide path, I think you're very right. That signal is very clear from Michael. By the way, Michael was my advisor when I was at the IMF, and I think he learned a lot from, he was a very hard monetarist in those days, and I was not. So I flatter myself that I kind of softened his monetarist inclinations. Anyway, hard monetarist. But yeah, the glide path suggests that a very gradual path, you're quite right. And which also implies quite correctly, you're saying that we are not going to be in a hurry to kind of outguess the Fed, more likely to be the other way. I think these 2 points go together. They reinforce each other. On energy prices, I would say there is, which we haven't discussed, maybe others will want to chip in after Charan has spoken. But there is talk globally of stagflation. Of course, it's usually, again, the hard monetarists, I don't know what else to call them, who raise such issues. Besides the valid point about asset price inflation, which is very valid. But I don't think the majority of people believe it, because then that is where this issue of how long the supply chain disruption will last and whether they will translate into inflationary expectations and further inflation, right? It has to go through a process. So there is a lot of disagreement, but obviously one has to make judgments about it. And as I said, that majority of what I've heard on international TV, business TV, seems to be people are saying that it will not be translated into further inflation. Obviously, when there is a jump, there's a jump, but that's not inflation. It has to go through a process and go on to further and further inflation. That process is what they doubt is going to happen. But that's a matter of judgment if anybody else wants to come in on that. That's what I hear on the international side. Now, I think, again, you're very right, but on China, because that, again, is going to be an important story, my perspective is that people are missing the politics of it, the geopolitics. Part of the reason, which has not been noted very often, is that the ban on Australian coal remains. So either you go and buy indirectly because the supply, if you cut out Australian coal completely, the supply is down, right? What you would expect in a market for coal is that they will sell to other countries. But if they are fixed contracts, that may not be happening. So what China is then would be doing, this is not a firm story, I'm just giving that as a potential what's happening, is that what they are trying to do is step up their inefficient local coal production, which also raises costs, right? Just by, if you go to lower and lower qualities of coal, the cost rises just automatically. That's the logic of natural resources. And therefore, that is putting the pressure on it. So, in fact, what they could easily do is lift the ban on Australian coal, let it go into normal markets, including their own, and this problem would be over, in my judgment, because I don't see a huge sudden imbalance in the overall supply. So, it's the geopolitics of China is a whole different thing now. It's not what you would have done like 4 or 5 years ago. That analysis, you have to be very careful. So this I'm just adding to what was said, Mr. Nagarajan. And finally, on vaccination, by the way, I want to make clear though Charan said it, but you may not understand. We did a propagation. Our paper on the second wave was the first to show that this new variant is different. It's very different. It's going to spread very fast, purely from the data on the spread across states. We looked at 22 states before even the name Delta was given, based on the spread and looking at 22 states and modeling the spread. We said that this is a different variant. Nobody else in the world said that till the Delta came. And based on that analysis, we said very clearly that this will rise very fast and decline very fast. And that is exactly what has happened. It's happened in India, it's happened in UK, it's been a little slower in the USA, this rise and spread, because of this whole dichotomy in vaccination between, so you get average numbers which are not very, which get mixed up because half the country is well vaccinated, over vaccinated, the other is under vaccinated. So you get these confusing pictures, but by and large, that story has played out exactly what we predicted. And based on that prediction of the spread and decline of the virus, we made economic predictions. Again, those by and large, 90% of those have come out right. So our thing was not based on what is happening actually, it was in our model. And the model we validated continuously till August. And after that, of course, I haven't, because that was enough. I mean, by that time, the actual reality was coming in. So that's something for people to remember. And I think your very interesting point, which I would have thought others also from the banking sector would have made, but you made it, maybe others can chip in a little bit if you want to add to it. This whole festival season, because I know you all watch this, what's happening in the festival season. I don't know, now or maybe after Charan finishes, you can tell us a little bit more if you have information on that. Charan?
Yeah. So much has been said, and I agree with and endorse most of the views that have been said. On the growth rate, I totally agree. We are in that ballpoint figure of 8.5 to 9%. But I do feel the sentiments are very high as we enter the busy season. And if you see the market behavior, and when I interacted with two different sets of market participants, one is MSMEs and one is my friends back in industry in Bangalore, the sentiments are very high. Let me give you an illustration. The industry is very positive. Markets are up, as you already mentioned. You will be surprised. The discounts on the car prices are over. They're not offering any, because they say the demand is so high in the market. So discounts are over. And that is something very interesting to see, how they were inducing people to buy these, and now that's not there. So the high frequency data on sale of cars, on two-wheelers, on tractors is really, really high. If we even look at the data which has come as far as the core industries, and which accounts for nearly 40% of IIP, there's been positive trend in almost all of them. And of course, the IIP data expected soon, but if you see the last IIP data of July, that also was very high. So my own take on the growth is that we may do more than we expected. As 20.1% we expected in July, in April to June quarter, we may expect a much higher growth rate in the second quarter. And the third quarter, of course, as the sentiments are high and market indications are so clear that the sales are increasing tremendously. Now, with the vaccination drive having taken place at the pace which is unprecedented, labor is returning back in the market. And that is, I think, which is giving positivity to the growth story. Now, when it comes to inflation, there is a survey from IIM Ahmedabad, which shows that the year ahead inflation expectation is lower than what it was earlier, what it was in July. So that shows that the sentiments on inflation are stabilizing, and that in a way means that earlier, that argument that was being forwarded that inflation is high and therefore the interest rates need to be raised is no more there. When we look at the international scenario, as you rightly mentioned, there is now a very strong feeling that the high inflation is transitory, be it the US, be it Europe. That transition thing is then preempting the raise in the interest rates everywhere else in the world. The Fed Reserve has not raised it in their September 21 policy. The Bank of England continues to be at 0.1% and continues to purchase bonds. The Eurozone again continues where it was earlier. And of course, Russia has increased it a couple of times. They have raised it by 25 basis points recently as economy is recovering. Brazil has raised it 5 times in the current year, and the last one they raised it in September 22 with inflation touching double digit. So on the EMEs, Russia and Brazil are the two outliers in that sense. Australia hasn't changed it. And looking at China, that brings in lots of uncertainty, partly discussed as far as the energy price is concerned. But I was also very worried about their Evergrande episode that has happened. And I'm not sure how it is going to play out in the financial circles. There are different readings on Evergrande, and that could spill over in other segments in the market, and that could be really, really dangerous. Now, as far as the banking sector is concerned, the stress on the banking sector is expected to increase. That is obvious, and that is worrisome. I have had an interaction with a couple of friends in MSMEs in recent past, and I can tell you their worries. And this will substantiate what Siddharth Sanyal was mentioning. They're worried about the raw material prices going up in the MSME sector. And the worry is, as yet, the export market is not totally open, but once the export market opens, then the raw materials are going to become a concern. The distribution channels are disrupted in the MSMEs, and they're worried about that. One illustration they gave me was the yarn prices shot up by 20% in 4 days in the recent past, and there's been no reason, no correction for that. They also, I understand that during the COVID time, the prices shot up by 15 to 30% and never recovered back. So that is already factored into the cost, and therefore the profit margins of the MSME sector have been further squeezed. Now, when it comes to the monetary policy and MSMEs, and of course I'll come to the fiscal part in a minute, when it comes to monetary policy and the MSMEs, the interest rates are pretty high in the range of around 12% for MSMEs. And they feel it's very high and no concession rate has been provided to us. Even when it comes to loans, the MSMEs feel that the collateral was always being considered for MSMEs, and they were looking if the RBI can consider some concessionary rate for MSMEs, as well as easing the terms of loans, and so that the collateral requirements are scaled down. Now, as I've already mentioned, that if exports open up, the MSMEs feel that the price pressure is going to increase and their profit margins will squeeze. Now, as far as the government is concerned, the fiscal has been doing better than any one of us would have expected. The August collections in GST, if that's an indicator, are very good. And in September, they're better than August. So that also reflects in the government's borrowing program. They had anticipated 7.24 lakh crore of borrowings in the first half. They did slightly less. And for the rest of the year, the borrowing program obviously is as planned. But my feeling is that if the GST collection and other collections improve the way it has done, then the borrowing program will be moderated to that extent. So given this scenario, as I look at it, then it is given the uncertainty, wait and watch is the best policy. So I would say the Reserve Bank, and I would recommend, continues with its accommodative policy. When it comes to the rates, I would say the best policy would be to retain the rate where it is and not to tinker with it as of now. When it comes to the post-COVID recovery, as already been discussed, and I totally endorse that the third wave may not come, or if it comes more like a ripple than a wave, then continuity and the green shoots that have emerged need to be strengthened. Therein, I would recommend that the Reserve Bank needs to take care of some of these post-COVID recovery sectors, where most of it would be accommodation for the MSMEs. So if some cost reduction can be done on interest rates and some relaxation can be provided on collateral so that during the recovery phase, of course, there's a government guarantee there, but during the recovery phase, MSMEs are able to raise more resources at a lower cost. Thank you.
You, Upasana or Siddharth, would you like to add anything, given what others have said? Do you want to add any points?
Yes, sir. I think I'll just take up 1 or 2 points.
Yeah, sure.
One is you mentioned about the festive demand. So I just thought I'll provide some feelers that we are getting.
Right.
One is that especially, like we have one automobile segment, lending segment there. And what we are seeing is there is very heavy demand there. The problem that the auto sector is, of course, facing, which is again known, is the shortages because of the semiconductors. So the inability of them to really supply, that is something which is a bigger challenge at this point in time. And that is where we would probably see disruptions. And that disruption in itself will translate into higher pricing because demand is there. So we'll have to see how that really plays out. We don't know yet, but that is a very clear indication that is there. So the footfalls are there, everything is good on the demand side, but the supply seems to be extremely constrained at this point in time. And this is something which will continue for sure. So that is where there is a little bit of uncertainty with regard to the offtake of festive demand, because the delivery, if it doesn't happen, then we don't really get what we really are looking for. So that is one problem, which is a very common thing which is featuring. On the policy front, I just like to highlight, I don't think anywhere any of us are signaling or suggesting a tweak to rates anywhere. So, if you see, consensus view is amongst all of us that the repo rate clearly is far away, for any change that we are talking about. If at all, any of us are talking about the 8.5 lakh crore of excess liquidity which is there. Now, all the problems that we are talking about are sector specific, MSMEs. Despite this 8 lakh crore of excess liquidity with the banking system, it is not assisting the sector who's actually under stress. So we don't need this surplus liquidity on a generic basis. What we need is a very targeted approach to handle the crisis for the distressed sector. So I think that is one thing I want to highlight, that this excess surplus liquidity, which is obviously resulting in a distorted shorter end of the curve, which has to be corrected to a normal level. It is not to say that we are talking about a full-fledged policy rate hike, but yes, the overnight rates, the reverse repo, that 65 basis corridor, that has to normalize so that the central bank does have the tools available to address any crisis as and when we face that kind of crisis on either direction. So I think that is very important to keep in mind. So this 8 lakh crore is where we are all talking about. This needs to be mopped up at a higher rate. So first is going to be a higher cost of that surplus liquidity, and then we start mopping up that surplus liquidity. So right now, I think the focus is on trying to just increase the cost available of that liquidity at the very, very short end. And that's how slowly we will start moving up. So I think that is the point we're trying to all make. Just that, yes, in October itself, don't think much is going to happen. It will take its own course. It's going to be very gradual. And another point on, I think, Michael Patra, the kind of glide path that he has suggested, the way I see that really is that 3 years down the line, a 4% inflation is not something which eventually the central bank will be happy with. 3 years is a long period. So while today where we stand, we may talk about this as an acceptable glide path, but I think this will somewhere start faring, becoming a cause of worry. So in the next 6 months, nothing else, probably another 12 months, no change to repo rate. But we will have to see how inflation and all of this that we're talking about, inflation expectations, persistence of supply issues, how they really play out. And that's when we will have to take a call on repo. So repo remains unchanged without, there is no question on the fact that repo rate will change over the at least 9 to 12 months.
Right. Okay. Thank you. That you want to add something?
Yes, sir. If I may add, I was thinking about speaking about on the same thing on MSME, but Upasana possibly articulated it much better than what I would have done. So basically, this particular issue is persisting, that even when we were flooding the market with liquidity, even when we were cutting rates aggressively, very clearly there was a segment of asset prices which was getting benefited, or even getting into some kind of a bubble mode, or at the most, some of the larger corporates were swapping their previous high cost debt with low cost debt now, but not necessarily at where actually activities are taking place. A lot of liquidity and lot of bank resources were reaching to that particular level. I think at that point of time, now we have come out of that particular scenario, and the survival part possibly has been taken care of with a reasonable degree of success as things appear now. But going forward, when it's a question of refixing the economy or helping the economy to revive, I think a greater focus very clearly needs to come in this particular aspect. And here there is no point expecting everything to be done by the RBI or monetary policy alone. There has to be a very significant involvement on various stakeholders, very clearly monetary policy, fiscal policy. But given that we are talking in this particular forum, it possibly makes ample sense to highlight the industry bodies would also have to play a very significant role. Various industry bodies chambers, etc., would have to play a very significant role in terms of helping policymakers to take some kind of a very clear view so far as this particular aspect is concerned. So that remains very critical. And finally, that as we mentioned about the possibility of a rate hike or liquidity absorption at any point of time, relatively, at some point of time it has to start. At somewhere, but the RBI would have to also kind of guard their reputation, etc., that they are very sensitive to inflation risks going ahead. But I think given their communications all along had been that they are data dependent, but they had maintained a dovish bias in the current scenario, and rightly so. So going ahead, there is no point to expect or even fear that they will be deviating significantly from that point of that particular stance dramatically and all of a sudden. All their communications are suggesting that. So they will possibly try to choose, as and when they do, the kind of combination which is possibly least disruptive. And so should not be too much of a disruption straight away for the market immediately. And one last point, that when in 2020, if I think that 2020 extra accommodation had been the rule of the game across the globe. Now, if I look back, that which country has done what extent of rate cuts at that point of time, India's rate cut, though sitting here, we feel that India has done significant amount of rate cuts, but compared with some of the other peers or most of our other peers, India's rate cut had been fairly nuanced. So as a result, when there is a bit of when the tides are changing, there is no additional pressure on the Indian MPC to embrace the rate hiking cycle in a hurry, and they can actually possibly afford to err on the side of caution rather than jumping the bandwagon in a hurry.
Yeah, thank you. That's a useful point. The comparative picture, I think, is important to keep in mind.
Yeah.
Yeah, so let me actually, partly based on what a question I see here on the chat box, you know, that I remember till, I don't know, maybe till about 3 to 6 months ago, in many discussions with RBI and outside, people used to say that one of the most important things is to address the NPA problem when we are looking forward into the recovery and regrowth phase of the economy. So that my question is, to what extent, I mean, what is your view now, given that the bad bank has been formed, etc., that, you know, in some ways, this was the big demand that government has delayed, that we've been talking about it since 2014, we've been talking about it since 17, in 19 and so on is not happening. It's a key reform on which must happen if we are going to get back to the normal growth path. Now that it's happened, in that perspective, would you like to say, I mean, I'd like you to say something on how you see, the economy from that issue perspective. Yeah, please go ahead. Upasana, you want to speak?
Yeah, sure.
Anybody, yeah.
So again, I think clearly, the kind of crisis that we've sailed through right now, the NPAs will continue to constrain for a while. All banks, I think even the second quarter will be seeing a rise in NPAs. And that is something which should constrain availability of resources. But at the same time, because the demand for credit at this point in time is weak, we have time before which the banking system can stand steady, and by the time the demand picks up solidly, they would be in a position to really finance the requirements of the system. So we do have time, and at the same time we should acknowledge the fact that despite the crisis, the policymakers have managed to ring fence the problem so much that the banking system has not really come under as much stress as what we would have expected in the beginning of the pandemic. So I think clearly NPAs will be rising through the course of this year. There will be realizations, but at the same time, the banks have made significant provisioning. So, all of this should eventually even out and help the banks come out of this. So in the course of next 6 months or so, by the end of this year, banks should be in far better positions to manage it. Now, talking about the bad bank, yes, the recoveries are already underway. And very recently, some of the bigger PSU banks have managed a good recovery from the DHFL and all. So we know that things are already in progress, and the bad bank concept is also going to help them manage with all the recoveries far better. So it does provide robustness to the banking system to that extent, and I think this will definitely aid. But even without a bad bank, I would have thought that, in the next few months, we would have settled down and we would be in a position, the banks would be in a position to finance the requirements, because it's a slow recovery. The CapEx cycle will take its own time. And unless we don't really see that level of demand coming back into the system, I don't expect credit growth to really pick up very rapidly. The working capital related requirement for credit is not going to increase the requirement meaningfully. What we need is a very big CapEx revival. That's when the demand for credit is going to be much higher. And so we have time to tide over the problem.
So I guess if I reframe it, in some sense, the formation is timely. It's not too late, not too early, kind of. Would you agree with that characterization?
Absolutely.
Yeah. Okay.
Absolutely.
Anybody else want to comment on that? Otherwise, we can. Sharon, do you want to pick up some? I mean, there are one or two questions.
I wanted to hear Siddharth on this because he's from the Bandhan Bank, and I know that in the MFI section and in the SHG, stress is very high. And I was wondering what is happening at the Bandhan Bank. So I don't know if Siddharth is still hearing and would like to contribute. As far as your question of the bad bank is concerned, you're right. The timing has been appropriate, but it's too early to say how it'll take shape and what all assets will really get transferred there. The banks are watching the scene. Upasana is very right. There has been good amount of recovery at different places. NCLT and all that has done very well. But then the bad bank being there as a backup is very reassuring to the commercial banks. But as the year comes to the close and reckoning of these bad assets are taking place or non-performing assets are taking place, and how the bad bank is used at that time will be very, very important. So it's too early to make a judgment, but it's very reassuring at this point that there is this institution we can fall back upon.
Thank you. So should we Is there any question or should we close the session?
I thought there are quite a few questions. Mr. Narendra had a couple of questions. So I do not know if he wants to ask himself. Mr. Narendra?
One, of course, I had some of the questions are already answered. That is the last policy time. One of the members, had dissented, and he wanted the accommodative policy to be at least that could be reversed when the repo rate is kept static. So, of course, current view and all from the panelists that these both the things will continue. But my point is, when exactly the accommodative policy can we expect that to be reversed? Second, in spite of the 8 lakh crores of liquidity in the system, and the 10-year yield has tightened from the last policy, and the bids are going for a higher level of coupon, and the Reserve Bank is also now later accepted that, and they have been starting accepting unless it is such a high rate, they they cancel that. So that means why, in spite of the liquidity is not much affected, still the 10-year yield, why they are moving up? That means whether the underlying inflation or the market expect the Reserve Bank to any time to reverse, because there were some of the on the review or feedback. One of the, I think somebody said that at least 0.15 or 15 basis points interest rate can be increased, but not necessarily now, at later date. And one more, just because all of them are economists and all, I feel that all of us has talked that the global prices have gone up. Domestically also, like steel, plastic, and all the major items have gone up. And Charan Singh clearly mentioned there is no reduction in the raw material price, and MSMEs and all definitely would have got affected. And in spite of these prices going, and one more aspect before I come to that point, that the whatever interest rate brought down has helped the corporate to really deleverage, and they paid back the bank loan and they raised money from the market, and they are really in a better position, and that's why the credit growth is not taking place. But the MSME per se, they are not much benefited. So in that respect, in spite of these prices going up, the underlying inflation being still high, are the current whatever inflation we are talking about, is it that whether fairly reflect the real inflation? That is my one another question. And as Charan Singh covered also that because except in the government guaranteed scheme, where the government said that the interest rate on MSME in the earlier phase 9.5 and later at 7.5. In other cases, that naturally the MSME, because of their rating, which are not up to the corporate rating, so naturally they will be charged higher. The banks cannot help it. Now, is there any either the government related or the Reserve Bank related? Can there be something beyond whatever measures taken by the government and the RBI for MSME? And can there be even though it is not required, it's not correct, but from the benchmark rate, if they fixed what is the spread, irrespective of current for a while, their rating, then can that not help the MSME? One more last point is that as we rightly said, the direct tax, indirect taxes have gone a buoyancy, and whatever the low interest rate having resulted in a higher profit, the government has got the right benefit in terms of these taxes coming to their kitty, and their availing of fiscal deficit has come down substantially. So can there be, because one thing is under the credit guarantee scheme, leaving aside, under the equity oriented scheme by the government for MSME, there are hardly any takers, even though they have extended the scheme up to March. So can there be some fiscal push to the such of the sectors which are really affected, like other than further giving guaranteed loan? What else can be the government do in terms of MSME or the, of course, hospitality sector improved, and aviation or tourism and such other sectors which will be taking a longer time to recover. So can there be a fiscal measures by the government? These are my some questions.
I want to actually, this issue of MSME credit and rates and all, I think is an important one, which is a perennial one. I've dealt with this for, I don't know, 50 years. But let me give you some general, lessons. I'm not saying that they are the ones like 100% applicable now, but some lessons we've learned over, decades and decades and from many countries. One is that you can't permanent large subsidies, whether it is for type of company or type of sector or type of industries, don't work. Okay? But small, limited time subsidies work. Now, what is it? This is something comes from growth theory. I've studied the growth of Korea, Taiwan, all these countries. There's a long history of experience. So why is this, right? There are two important factors. One is that when you give a small subsidy, it's a good signal. You give a little bit of extra help so that it's only if it is efficient and sustainable people come into it. But it gives a signal. They say, okay, I will it require a little more effort for me, but because I have this little subsidy for 2 years or 1 year or whatever, that we can discuss. That is exact is not known, but for a small period, it works as a signal. It gets a little bit extra so that they can come in, but they have to be competitive eventually, because otherwise you give large subsidy and continue, it always results in corruption. Okay? It is never sustainable. So that is one thing one must keep in mind. Now, based on this is exactly my points, and let me explain how it's important. The 3 points I made are very clearly related, though I didn't link them. The important link is this. It is possible now, given the digital system, to link the GST, the direct tax, and the customs for all MSME producers, especially for exporters. And once you link them, you can link it to the credit system. It's automatic. You should be able to have a system which automatically, at the lowest rate possible, gives you the credit because you know everything that is happening. So what does that mean is there's a permanent reduction in costs of giving credit to MSMEs, which will result in a permanent reduction in interest rate and a virtually automatic credit. Those are the kind of things we have to think about. And that is why it is so important to simplify the GST and customs and link it to the credit system, both of them. Same thing works separately, even if you are not an exporter. GST, if you are linked to the credit system, and it is simple, and which is where the simplification is absolutely critical. As long as it is complicated, the same problem arises. So what we have recommended is that 15% GST for about 3/4 of the goods will take care of this. 90% of MSCs will only have one rate, 15%. It will be so simple. Once you link that GST system credit, you can get automatic credit because everybody knows what is happening. Okay, you can file returns, you can have on a spreadsheet, you can have all your data, and it can all be connected to your bank. It can be connected to your GST fellow who should automatically give you the credit. Okay, so cost reduction through tax reform is a major thing which people don't understand because it is behind the scenes, which is what I'm been trying to stress, and I'm glad you asked the question because it's hard for most people to understand. And as I said, I repeat, I think organizations like ASSOCHAM, FICCI, etc., must push this thing because it's hard to understand. The tax fellow or the governments who are part of the GST council just think of, "Main ye rate badhaunga to I'll get more revenue." They are not able to see the whole system and how this whole thing, when it is so simple, it will be so much more compliant and you get more revenues. Okay, but it's too complicated a process. It's like saying, how can I get more revenues if I make everything at 18 to 50? Well, you will, because you're going to combine your 12 and 18 and you're going to clear up all this bloody mess you have right now. Okay, sorry for that long reply. Anybody else want to pick up? Yeah, Charan, some of his other points?
Yeah, one thing is there when I was talking and interacting with the MSMEs,
Yeah.
and of course, Sanyal is back, like to hear from him too.
Yeah.
The point which chairman has right now made, they were very disturbed. They said, 5 months back, the rate on this item was 5%. This time they have raised it to 12%. And he said, how do I handle this? Secondly, they said, as an MSME, we don't have the privilege of having accountants sitting with us and learned chartered accountants. So for us, this is an additional cost when you change the rate and you change it so easily. Some of you sitting there and that do not understand that we suffer the most. The third point, which Chairman said, and I just would like to elaborate, my own understanding is in MSMEs, say pharma, they don't need any support. They are excited, they are thrilled, they have made beautiful money this time. So they don't need, and pharma not only which is related to COVID related medicines, even pharma otherwise, because they were telling me that their patients have started stocking medicine, not knowing what is going to happen. And all medicines have a standard expiry date. So they do not see any lull in their business. So they have done good. But there are certain sectors in MSMEs, say garment, now viscose, and then polyester. They were saying simple single firm does control the whole polyester in the country. And they decide on their women fancy, chalo aaj 20% बढ़ा dete. And it increases. But this guy who's selling his product and who has the brand name or who has got the cost already fixed, what does he do? So therefore, the government intervention has not only to be in terms of providing subsidy, it can also be in providing stable rates of GST, as well as ensuring that input costs are not at the whims and fancies of one or two big monopolists who control the fiber. So
Excellent.
government can play very prominent role. The last point I want to make is the government can also identify the MSME sectors and exactly the way Upasana mentioned it. Certain specific sectors which need assistance and help, and these are available. The know-how is available because all the trade associations have verticals on MSMEs. MSMEs themselves have trade bodies. The moment you talk to one or two of them, you'll get an idea where the stress levels are. And why I'm insisting on MSMEs? Because in the post-COVID recovery, when labor is back, these are the industries which absorb maximum labor. So to ensure ease of doing business for MSME is going to help us in the recovery phase.
Absolutely. Charan, thank you a lot. I'm sorry, but I want to give this because it's so important. At least ASSOCHAM can take up. There are like 20 different rates on imports of textile materials, okay? Because they are specific rates. For a long time, I don't know whether they've changed it, the excise or now GST on polyester and viscose, which you mentioned, was higher than cotton, where everywhere else in the world, it's supposed to be a common man's material. So with the result that our textile exports are abysmal in mixed fabrics and polyester. So just simplifying all textile materials and textiles into one rate 15 and all import duties on textiles and textile materials to one rate 10, let's say, just for example, it could be a little bit here and there, it doesn't matter. You would simplify the life of all exporters and all importers of these materials and producers so much you cannot imagine. See, people just don't understand this. I don't mean people like us who are thinking about these issues, but the bureaucrats, the politicians, the states don't understand what revolutionary change that would be. Because a guy may get an order which says, let's say 3% of polyester or 4% of viscose. Another guy may get, or next day he may get the opposite. Every time he has to change the thing. Okay.
Yes.
If it was all 15%, it becomes trivial. He can just shift. He can supply one day, next day he'll give the other. There's no complication of taxation. Yes. And they just are they cannot comprehend this thing, you see. And it doesn't going to cost you anything. It's just make it average, whatever it is, right? So
But
I'm
when-
glad we've had this discussion
Sir,
because
Chairman
me-
Sahab,
let me-
Chairman,
no, just a
Chairman-
minute.
Yeah.
Does
Yeah.
Mr. Sanyal or want to add something,
Yeah,
and then
yeah,
we
yeah.
come back. Yeah.
Yeah. Okay.
Siddharth, do you want to say something, or should we? Yeah.
No, I thought there was a comment from Mr. Narendra, not from me.
Okay. Okay, Narendra.
Chairman, no, Chairman, no, mine, the
yeah.
comment is not that. What I'm telling, as Chairman has said, the
Yeah.
integration of GST and excise and all,
Right.
keeping in view, which can be integrated to credit. The NFR, the National Financial Reporting Authority, has suggested up to 250 crores of turnover under MSME. They
Yeah.
need not be audited by the auditor. That is the one
Yeah.
paper they have released. So your
Right.
point is 100% taken, sir. Bank can have all the data now. And another thing is there is a aggregator also coming who will give the data also. With all that, MSME credit should become online and very
Exactly.
turnaround time should reduce. So your point is similarly other side government can push some of their whatever subsidy and measures. So that point of yours is very highly correct, sir.
So simplification and integration. You see, integration
Yes.
becomes too complicated if the tax system, if the subsidy, even subsidy. Yeah, I agree. If some subsidy, export sub credit, etc., some simple rate, one small rate, and integrate all that. Sorry, Sharon, you were going to say something?
So the point I'm making is in canons of taxation, as conceived by Dalton more than a century ago, there is the canon of certainty. I should know what rate I'll be charged. But every few months, if you change the rate of taxation, then this poor MSME guy who can't afford a chartered accountant, and no chartered accountant wants to work for a small MSME because they would like to work for E&Y and Goldman Sachs. So these are the guys on the receiving side. The point that repeatedly was coming up, what is the justification? And we are all learned people. What is the justification of raising the yarn prices by 20% in last 1 week? So where does the manufacture of garments go? And then you say that Bangladesh has overtaken India. So there is
Okay,
something
good.
which
So let us move on. If they are final, we have only 7 minutes left. If there's any comment or any, well, Mr. Narendra had many questions. I thought some of you may have some response to that, but that's okay. If
I
that's,
would like to take the question from Nikita, if Nikita
Okay.
is there.
Yes, I'm still here.
yeah, okay, go ahead. Last question, right?
Yeah, I was just mostly concerned about the structural issues in the country right now. Like which one do you think is the most important? Like from my understanding, the financial sector right now is really riddled with the non-performing assets, and the laws, even though put in place, they are not really doing as much as they should have done. So how big a problem do you think that is? Is it really that structural or it's not?
So, as we were discussing, perhaps the direct link was not clear, but the set of reforms starting with IBC and the bad bank, in a way, much of the structural reform, that was my clarification I saw from the banker's perspective. Maybe again, Siddharth can add something, but from my macro perspective, that whole set of things have actually now been resolved. What has not been resolved is the points I mentioned, the major macro point that all three taxes need simplification and reform. But Siddharth and Upasana, if you want to add more on the financial system.
Sir, maybe if I just add to, no one can disagree with this particular point which you mentioned, and from a more formal banking sector point of view, this is possibly is the most visible one. If I take a step back and come a little closer to away from the financial world and come closer to the real world, one particular aspect that has become very a strong factor over the course of the last 18 odd months. So whenever we had been talking about the resilience part of Indian economy, a big source of comfort for us had been it was a cliche, but for a fairly long period of time, we had been talking about that if India is not growing, Bharat is growing and stuff like that. But one particular development along with the hit for the informal sector that we have seen over the course of the last 18 months had been a bit of a hit for the semi-urban and rural India as well. there has been, there has been a set of vulnerability which was not really, earlier it was not a binding constraint, but it has become a binding constraint. The lack of availability of health health facilities and stuff like that, it has become very, very apparent. Now, if I just try to see how the long-term growth forecast from various multilateral agencies, etc., for various regions and countries have changed over the course of the since the breakout of COVID. Basically, we get to see that India, as per someone's definition, or for if I go by the IMF definition, they very clearly speak about India. If we go by the World Bank definition, they speak in terms of South Asia, which is, in other words, India. There, the loss of GDP on a medium-term basis. That means if I'm taking a 3 to 4 year forecast, 2024, 2025, and how 2024 or 25 forecast have changed today compared to what we were forecasting in January 2020, for example. So there, the loss of GDP on a medium-term basis, in case of India, has been very significant, if not the highest globally at this moment, which is one particular factor which is becoming, which somehow with intervention of policy, we possibly would have to address. Because I refuse to believe that over a longer period of time, we cannot make a bounce back. Because one particular, the reason I wanted to say this, I earlier said that the risks to the near-term growth recovery is possibly underestimated. At the same time, I do have a hunch that the possibility or potential for medium-term recovery in India is also possibly underestimated. The reason being that when we had actually surprised on the growth front in the past, in the previous 2 decades, this was more on the basis of our high-end manpower and high-end services industry. Now, over the course of the next 3-4 years, if remote working, hybrid working, I'm talking about in a global context, becomes more of a norm rather than exception, then possibly India can actually leverage out of that particular situation in a much more significant way. But we need to have very clear policy support intervention at various levels for that. And I mean, there's a very clear need to focus on these aspects. And that's all I wanted to highlight from a very structural point of view.
Thank you. Again, a point, I'm glad you raised it, because in our Vision 2050 paper, which Charan can give you the references, we've reflected on this issue of the divide, which you are absolutely right, is very important. And the solution we expect, is basically the new digital economy. So we feel that government has to provide 100% connectivity to every village. And there is a program, I think it's too slow. Government has reiterated it, but again, I'm not sure people really see the importance of it, because this is going to be the source for all these other problems that you mentioned. Health, e-health, it can completely, there is no way you can raise the quality of the rural health system to the urban without using for non-invasive procedures. It can all be done on the internet. You don't need to be there. So that quality gap on all non-invasive, it can be solved through the internet, through e-health. Same with education. You cannot have the highest quality teachers in every village, but you can have a teacher and then connect that teacher to a better quality person in the urban area, or even higher quality anywhere in the nation. And those systems, in my view, have to be and will be developed in the next 5 to 10 years and will be used to transform rural. So these, and you're absolutely right. I'm glad you mentioned work from home, because that is the instrument we see. Because even the divides like we see, in villages, SC/ST person is in a way constrained. They refuse to let him do anything besides what they think is his traditional thing. Well, if he is connected in a home to the internet, he could work from home, work on anything. They can't see whether he's working on X or Y, which they feel is to be working. Same with women in rural areas. The family or the society doesn't allow them to go out and work, but the work from home can transform. So in my view, the digital economy, and that is, for those of you who are interested in this issue, please read it. It's a IGRO policy paper you can find on our website. which provides a means of transforming the kind of rural environment and many kinds of services besides the social services can be delivered over this. So the government's role there is again not to just provide subsidies, but to make sure that that connectivity occurs. So the subsidy really has to be to provide the connectivity and provide access to in public schools. Primary schools are there all over, government schools. There are primary health centers, connect them, and then help the poor to use them for free in whatever way. So that systemic change, in my view, is going to drive the transformation over the next 10 to 20 years.
Sir, in a way, you said something like what Indian cricket has witnessed, that earlier it used to be a game played in the metros. And now when we source it from the hinterland, we see the difference.
Yeah, right. The knowledge, yes, exactly. So the knowledge of jobs, the connectivity with jobs will all be right in front of you. I mean, for the poor would still have to be helped in some way, but 50% of the rural population may have a small electronic device in their home, and the others would have to maybe go to the local school or the service center. So anyway, with that, I'm sorry, I've spoken a lot today, but the topics came up. So thank you all. Thank the participants who contributed to the discussion and for the questions. Charan, with that,
I must thank everybody for participating so actively in today's discussion. We have had two guest speakers and both of them have contributed significantly. I must thank SHM for hosting us. They are our constant partners. I must thank Mr. Narendra having asked such important questions. One question, of course, which was partly answered was when will RBI start the reversal of their accommodating policy, which I thought in a way the panelist had answered, saying that they will not like to preempt or rush into it soon, and we'll see how it all plays out. Especially we'll see what America does, and that's where all the flow of money comes in. So I thought that that was answered, but I think it's a very important question from the angle of industry, because the industry wants to know when will the interest rate rise again, and if they can take the advantage of a low interest rate as much as possible. So it's a very valid question. I'm sure that when we meet next time, 2 months from today, this question will still be asked, because on 8th of October at least, they won't change the rate. With this, I want to thank our chairman, Dr. Arvind Virmani, who's been in the helm of policy making. And today we came to know he has also mentored, and in that sense also helped one of the deputy governors become more balanced and not only be a hard monetarist. So he's contributed significantly in knowledge as well as training people to handle public policy in a more responsible way. So with this, I would like to thank each one of you for such an excellent discussion. I hope you have benefited from it. We'll be putting this, SHM will be putting this straight away on their website. EGRO will also put it on their website. And if you feel like sharing with the policymakers, please do so. Today's discussion has brought forth a very important issue on MSMEs. I would leave it to the discretion of the top management in SHM if they would like to organize a conference on challenges facing MSMEs in post-COVID recovery phase. That I think is exactly what the chairman also mentioned. I was also thinking, and Mr. Siddharth Sanyal also brought it on the table. Very important topic if we have to sustain the employment part. But that is at the discretion of SHM. With this, once again, let me thank each one of you for playing an important participatory role in our today's discussion. Thank you very much. Thank you.
Thank you, sir.
Thank you so much, sir. Man,